Today I'm talking about if you are an investor and you're in the habit of investing in property, even the stock market, then you will be interested in knowing about the opportunity zones. The opportunity zones are designed to spur economic development in depressed neighborhoods, the depressed communities. A list of those communities are in the Excel file attached with this lesson. And the benefit you get as an investor in these depressed communities is you get a tax benefit, which means you defer capital gains. How much you defer depends on how long you keep the investment. So let's say you sell one of your investments and you have a gain from that investment. Rather than paying tax on that gain now, you can actually invest in an opportunity zone and defer the taxes on that gain. However, if you keep the investment for at least 5 years, you not only defer the gain, you also get a 10% of the deferred gain excluded from taxable income. And if it's for 7 years, you get 15%. And then if you keep it for over 10 years, you basically pay no taxes on the gain. Let's take a look at how this looks like in the Excel file. So here's the Excel file you're going to download below in the course. The opportunity zone has 3 parts, as I just said. First, the first part is the deferment of gains for monies you invest in opportunity zone. So when you buy and sell, rather than paying the gain in that tax year, you defer the gain. And then not only do you defer the gain, if you keep it for 5 years, you get to exclude 10% of the deferred gain. And if you keep it for 7 years, you get to exclude 15% of the deferred gain. And if you keep it for 10 years, you basically pay no money on the gain because your basis becomes your fair market value. And so by the time you take your fair market value minus your sales price, you get 0 taxes. So here's a summary of that here in the Excel file. So let's take an example and see an investor. They are going to invest $30,000. They sold their property and then they have a gain of $30,000. Rather than paying taxes on that gain, they're going to put that in an opportunity zone. And then they estimate that when they sell, they'll probably get $51,000 for the investment. So if they were to keep this investment for less than 5 years, all they will get in the current year is the deferment of the gain. So let's say their capital gains rate was 15%. They will get taxed $3,150. However, if they kept it for 5 years, not only do they defer the gain, they get a 10% exclusion, which is $2,100. So they get to pay tax on $2,100 less, which you can see brings their tax to $2,835. If they keep it for 7 years, they not only defer the gain, they get to exclude $3,150, which brings down their tax to $2,677. And if they keep it for 10 years, they get to pay no taxes. Obviously, it's an investment. You can have gains and losses. So this only works when you have gains. And also, if you're in a low tax bracket, then it really doesn't really make that much of a difference to you because you're not paying much taxes on capital gains anyway. So this is for people who are in the habit of investing and have decent amount of income. I should also note here that even though where I said deferred tax 15%, that tax is not going to be paid in the current year. It's going to be paid at a time of sale. So which means if this investor holds this tax for 4 years, they get to pay this $3,150 4 years later and not the current tax year. So the current tax year, they're actually paying 0. The same thing for 5 years and 7 years. That deferred tax is only paid when the investment is sold and not in the current year. Now let us take an investor who's making $250,000 in wages and they have capital gains of $30,000. So this is without them reinvesting that capital gain in an opportunity zone. And then the second scenario, we see that they actually invest in an opportunity zone, so their capital gains are 0. We can see that based on that, this is a married filing jointly person. So that's income for them and the spouse. They do get to pay the net investment tax of $1,140, and they get total tax of $48,459. So without the investment, they're going to pay $5,640 more in taxes. because with investment they get to defer that $30,000, but without investment they get to pay taxes on that. So that's a $5,640 savings. And every single dollar counts. So that's a savings from that, and then other things they can save on. So it's worth looking at if you have sizable income and you're in the habit of investment, because this could be a way for you to increase your return on investment by reducing your taxes. Finally, in the last tab, you can see a list of opportunity zones. You don't have to live in the same area where you're making an investment. So you can go through this list and see, or if you're not in the habit of investing, you can actually join a already established fund and participate. And, just like you participate in a mutual fund, you participate in a qualified opportunity zone fund. And basically the money you get from this fund will also be treated just like I have talked about in this lesson. You can get the free lessons and free templates by going to Bizexceltemplate.com. Like what you see? Go ahead and click the subscribe button on the very bottom of this video. I look forward to seeing you in future videos.